Well, welcome to our HighRock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best course of action for our and your investment strategy. We are recording this webinar, so those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also with us. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. Well, let's review quickly our themes for 2016 before we get started on what happened last week. Number one is that financial markets will be volatile. There is also a big question mark surrounding the U.S. economy. Will it follow the U.S. Federal Reserve's more optimistic outlook, or are less positive forces going to pull it down? Commodity prices, and especially oil, are having a deflationary impact. Can non-commodity prices offset this? We remain to see. The central banks of Europe and Japan and China are adding stimulus. The Bank of Canada and the Bank of England holding steady, and the U.S. Fed is tightening policy, a recipe for possibly greater uncertainty. Now throw in the geopolitical wild cards like the Middle East, Russia, and the UK leaving the European Union, which I'll talk a little bit more about later on in the call. And there's more uncertainty from that. And as they always have, bond markets will continue to hold the clues. We will follow that and those markets very closely. Equity markets remain expensive, although somewhat less so than last May. And we remain in a time of lower than average returns when, after 6 years of above average returns, and as all things do over time, they are moving back toward the average. So what's happened since our last webinar? Let's get right to the financial markets because there is plenty happening. It has been a wild ride since the beginning of the year. Last week, volatility spiked again, this time with the U.S. Federal Reserve announcement, and I'll talk about that a little bit more in the program as we progress. But on Friday, volatility eased as markets found buying support, and with the help of the Bank of Japan and better oil prices. But today, it is rising without any buying follow-through and softer oil prices. Now, oil prices are currently driving investor behavior because investors are fearful of the insolvency of oil producers and the impact that it might have on the financial system and on all risk assets. Well, volatility is above its longer-term averages, but certainly below the spike that we saw last August. CNN Money's Fear and Greed Index hit a low near 9 a couple of weeks ago, representing extreme fear, but has recovered since. Things did not get as fearful as they did last August, however. Our benchmark world equity index was weaker by about 0.5% over the week, and is now lower by a little over 7.5% on the year. Japan was the best performer since last Tuesday, and Euro stocks were the worst performer. Now in December on BNN's The Close, I suggested that it might be a reasonable strategy to be overweight the underperforming Canadian equity market and underweight the outperforming U.S. equity market for rebalancing purposes. At this time, that strategy appears to be working by a little over 2.5% so far this year. Our benchmark world equity index made new lows near 49 a couple of weeks ago, which was a 22% drop from the highs last May, before it found support from short covering and a little bit of value investing after such a large decline. The downtrend, however, remains intact as we are now experiencing lower lows and lower highs. A test of further buying support at the 49 level should give us an indication of whether or not this level holds any significance, but it may not necessarily happen soon. However, until this pattern and the downtrend is broken, we should be on guard for further selling pressure from those who are giving up hope. We will use better values to nibble away at this opportunity, although we are still sticking to our overweight cash thesis. In January, investors exited equity mutual funds by more than $22 billion in the U.S., and volume on the New York Stock Exchange jumped to the highest levels since 2011. That should give us some further indications of the strength of the downtrend that we're in at the moment. Well, on the week, Canadian and U.S. bonds were stronger, high-yield bonds were weaker, and preferred shares were the best performer in the fixed income area. The U.S. and Canada 10-year bond yield spread narrowed by 4 basis points as U.S. yields fell more quickly than Canadian yields over the course of the week. Commodity prices saw warm weather drive natural gas lower, and oil was also down, most of that today. The commodity price trend is still toward lower lows. Oil ended last week on a positive note as there was some rumors of the potential of for production cuts, but this week those rumors did not materialize. For the moment, the downtrend remains well entrenched. The Canadian dollar moved to new highs yesterday against the U.S. dollar, reaching close to 72 cents, but faded today with the lower oil prices. 2 weeks ago, the Canadian dollar hit levels not seen since March of 2003 in anticipation of further easing of interest rates by the Bank of Canada, but they held rates steady and the Canadian dollar improved. The Bank of Canada wants to see what fiscal policy measures the government will take before making any changes to monetary policy. Well, our benchmark World Equity Index is comprised of about 52% of U.S. companies, so we keep a very close eye on what is happening in the U.S. economy. The U.S. Federal Reserve raised interest rates in mid-December and held them steady in January, citing that they saw improving labor market conditions and increasing household and business spending, but were concerned with exports and the global economic and financial developments. Now that is code for higher levels of volatility around the world. As you all know, this is our key theme for 2016. The next meeting is in March. If current conditions persist, we would expect that this will likely keep the Fed from raising rates at that time. At a speech on Monday, Fed Vice Chair Stanley Fischer also commented on part of our 2016 theme of volatility, suggesting that higher degrees of uncertainty are persisting. Back in December, the Fed had a particularly optimistic outlook. U.S. Federal Open Market Committee members suggested an average of 4 interest rate increases in 2016. It appears that, as we have suggested in our previous calls, that they might be tempering their enthusiasm with the recent economic data and market turmoil. Well, the Fed's key inflation metric remains stuck well below target. It's well below its 2% target, and likely to not move much as commodity prices hold it back. The Fed suggests that this is a transitory situation and likely to fade in time and to let inflation data move higher, but they have been using that word transitory for well over a year now, and little has changed over the course of that period. Although it is ancient history now, the 2015 U.S. GDP results were announced last Friday, and with slowing growth in the fourth quarter of only 0.7%, the U.S. economy grew at an annual growth of 2.4%. Spending on services added 0.9% and was a leading contributor to the quarter, as was spending on goods at plus 0.5%. Residential investment and another measure of consumer health rose very solidly once again, contributing 0.3%. The negatives were on the business side, especially those facing foreign markets. Net exports pulled down GDP by 0.5 percentage point. Non-residential investment pulled GDP down by more than 0.2 percentage point. Reduction in inventory investment pulled the quarter down by 0.5%. We often say that the consumer is 70% of the U.S. economy. In 2015, consumer spending was close to 90% of the economy, includes spending on Obamacare, which may be somewhat overstating things. So for the moment, the U.S. economy is in the hands of the consumer. The question mark is, will the consumer continue to spend? Well, the consumer is confident, according to the surveys, but there is a gap between their confidence and their spending. In December, spending, as retailers already know, was very soft, unchanged, with only services showing a gain. December spending on both durable and non-durable goods fell 0.9% each. The former reflecting weak spending on holiday gifts and also vehicles. The savings rate, now this is very important, the savings rate climbed by 0.2% to 5.5%. Now last year, one of our themes was that consumer demographics were changing, that baby boomers were saving for retirement, and that the now largest cohort, the millennials, with high student debt levels, had less money to spend and had significantly different consumption habits. But more importantly, while they might be confident, they aren't comfortable spending. As it stands, they are really rather uncertain. And herein lies the crux of the issue for the domestic economy and with implications for the global economy. Can the U.S. consumer carry the global economy? It does not seem likely. If job growth stalls, that would be an issue. If wage growth cannot advance, that would be a problem. Continued strength in the labor market would give the greatest boost of all to confidence, though the employment report for January is expected to show substantially less strength than December. We should see that report on Friday of this week. The weekly jobless claims data have been rising since September. Meanwhile, manufacturing in the U.S. is in its 4th month of contraction, which certainly is a concern. And what we are more concerned with is what to expect in the future. The GDP now forecast for U.S. GDP in the first quarter of 2016 is at 1.2%, much lower than the consensus of 2.3%. It appears that, for the moment, the global economy and the global economic situation is significantly constraining the U.S. economy and appears to be winning the tug of war between the two of them. If this situation persists, it is likely going to impact the U.S. Fed's decision on raising interest rates going forward, and more importantly, the impact on corporate earnings growth and our desire to own the shares of companies that are overpriced in the equity markets. So what is happening in the global economy? Well, the euro area companies represent about 16% of the world equity index. The European Central Bank eased monetary policy back on December 3rd, but it was less stimulative than the market had expected. 2 weeks ago, amidst the increasing market volatility, President Mario Draghi surprised the market with an announcement of more stimulus to come, perhaps in March, which halted the selling and brought buyers back into equity markets. Inflation in the euro area jumped by 0.4% in January, but core inflation remains well below the targeted 2%. Unemployment was announced today, fell to 10.4%, the lowest level since September of 2011. So things looking up a little bit for the euro economy at the moment. Japanese companies represent 8% of the world equity index. In a surprise decision last week, the Bank of Japan, following the European Central Bank's path, chose to introduce a negative interest rate, aiming to achieve a price stability target of 2% inflation, which currently is well below that target. Well, let's take a moment here to talk about negative interest rates. In essence, when the Bank of Japan and the European Central Bank, what they are trying to do is drive money away from their currencies into currencies with higher interest rates. Specifically, that would be the US dollar. This helps to devalue their currencies and make their export economies more productive. Now, this should help add some domestic inflation to counter the current global commodity price deflation. The problem is that they are exporting the deflation to the U.S., which has a structurally stronger domestic economy because of demographics, but will in turn drag the U.S. economy down. So it is not necessarily beneficial on a global scale, and to date, the domestic benefits have shown to be marginal at best. Well, further, it is an attempt to force investors to move to riskier assets, to chase higher returns, to add buying pressure to reduce volatility. However, again, this is only a temporary reprieve. If global growth does not add to corporate profitability over time, then the fundamentals don't warrant the investment, and anxiety returns. It also encourages borrowing at lower interest rates. But as we have often said in the past, it now takes 10 times the amount of debt to get the same incremental increase in GDP as it did 10 years ago. So debt building is less efficient. At the moment, the global debt burden is at record, at the moment the global debt burden is at record levels, and the commodity price deflation is threatening to turn much of this debt into bad debt, which may put even more pressure on the financial system. We need to ask ourselves if this is an environment that we want to take increased risk in. Now, our suggestion is certainly not yet. Back to the global economy. Companies in the UK represent 7% of the global equity index. On January 14th, the Bank of England Monetary Policy Committee voted by a majority of 8-1 to maintain the bank rate at 0.5%. Policymakers said the outlook for growth and inflation had weakened. On the geopolitical front, the UK wants to renegotiate the terms of their participation in the European Union ahead of a referendum that may come as soon as June, whereby the good people of the UK may prefer to go it alone. There are significant economic risks to a UK exit. According to a Bloomberg story, there would be 3 shocks to the UK economy. 1, the confidence shock would create uncertainty over post-exit arrangements, and that would mean business investment would slip and household saving would likely increase, reducing demand. Number 2, the credit shock, as UK banks are seen as riskier and their borrowing costs would increase. And number 3, the currency shock sees foreign direct investment flows drying up over the course of a year. Even before that, investors will reassess the risks associated with Britain's large current account deficit, and the currency can depreciate significantly. We shall need to keep our eyes on this for the further developments, but if the UK economy suffers when it is one of the strongest of the developed nations, this could have broader implications for the global economy. Well, Chinese companies represent 2.5% of the world equity index. China's manufacturing index has remained in contraction since last March. Today, the People's Bank of China injected an equivalent of $15.2 billion into the monetary system in order to help maintain liquidity. The Chinese economy grew at an annual rate of 6.8% in the fourth quarter of 2015, down from the previous quarter and the weakest since the first quarter of 2009. For the full year of 2015, the GDP expanded by 6.9%, lower than the 7.3% in 2014 and the weakest growth in 25 years. The government targeted the economy to expand at the 7% level for last year. The Chinese stock market soared in 2014 and early 2015, but has collapsed since then back to levels that we saw in 2011. Well, in Canada, where companies represent 3% of the world index, the latest reading on the Canadian economy, though quite dated from November of last year, where the GDP increased about 0.3%, better than October's flat performance. So not recessionary yet, but a lot has changed since November. The always erratic labor force survey results for January will be released this coming Friday. To repeat the latest from the Bank of Canada, they are counting on a better second half from the U.S. economy to pull the Canadian economy along. The U.S. economy appears to be struggling, however, at least for the time being. Okay, so what do we see on the horizon? Bond markets lead other financial markets, so let's check in with them. The negative interest rate policy in Japan pushed the yields on short-date maturities lower. The Bank of Japan is trying to manipulate the yield curve into a positive slope, as is the European Central Bank, to project expectations for economic growth and greater inflation. As for the US, UK, and Canada, the slopes are still positive, but flattening with lower long-dated yields, and shorter-dated maturities for the UK and Canada are currently flat, which shows some near-term economic weakness is to be expected. High-yield bond markets lead equity markets, and the gap remains to be closed. As for equity markets, when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. The 12-month forward price-to-earnings ratio is currently at 15.2, higher than last week's cheaper 14.9. At the equity market highs back in May, it was 17.1. Now, with 40% of companies reporting for the fourth quarter of 2015, earnings to growth has declined by 5.8%, on revenue growth declining by 3.5%. Now, for all of 2016, analysts are projecting earnings increase of 5% and revenue growth of 2.7%. Now, last week's earnings for 2016 were projected at 5.9% and revenue at 4.4%. So expectations are weakening, making share prices still relatively overvalued. Remember that while equity prices, the green dotted line, have become cheaper in recent weeks, until they move below that line, the forward 12-month expected earnings line, which is also declining now, we think that they are still relatively expensive. Here is another look at earnings history, and it does show a disturbing trend lower. As for the other value metric that we like to look at, enterprise value to earnings, S&P 500 companies are valued at current market prices at near 12 times. Now, the long-term average is 10 times. Currently, this is too expensive for our tastes. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May, so it is something that inspires our current caution. Also, when the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000. When markets fell recently, that gap narrowed considerably. However, the fact that large cap markets have rebounded but not the small cap markets, that leaves us cautious at the moment. So what does it all mean? Well, since last May, we have taken a defensive posture to investing. However, we do see value beginning to appear, and our expertise has been recognized by the leading financial press. As our founder and co-managing partner, Paul, explained to Bloomberg, and also picked up by the Globe and Mail for a story in their online investing section, there may be good buying opportunities for investors willing to do their homework. At High Rock, we do our homework for our investors. Well, central bankers and most economic forecasters are uncertain of the path of the global economy. So are we. And as Paul suggested in the Globe and Mail article, we are quite fearful of the prospect of deflation in commodity prices. Our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to be and stay fully invested at all times. That is why most advisors recommend sitting tight on a fully invested strategy. In many cases, it is significantly more difficult to adjust assets and positions one household at a time, as non-discretionary advisors are required to do. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Cash and cash equivalents have been important defensive assets, so we are carrying greater than normal cash balances in our models. However, with equity market values having fallen so rapidly to begin 2016, we have begun to find some opportunities to add reasonably cheap assets. This does not change our defensive strategy. We are being patient and adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness and assets with better value if and when we should get it. Now, if we don't, we can and will adjust our strategy quickly. Risk is significantly lower now than it was last May, about 22% lower according to our benchmark World Equity Index, so where we are much more comfortable adding assets at levels where we see value. Our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. Now, as volatility increases, the cash and client accounts, the underweight nature of our exposure to equity markets, and the negative correlations between equity markets and bond markets help to mitigate the impact of volatility on our portfolios. So this year so far, our global benchmark equity index is down close to 7.5%, as I mentioned earlier. A typical 60% equity, 40% fixed income portfolio built with our models is down somewhere between 1% and 2%, depending on the structure. This is a significant mitigation of risk and volatility and is part of our ongoing active management. Okay, what's up for next week? Well, we have the Bank of England interest rate decision this coming Thursday. As I mentioned earlier, we have on Friday the Canadian Labour Force Survey and the U.S. Employment Situation Report. Next week, very quiet, but of course on Tuesday is the weekly High Rock webinar, which is an absolute must for any investor. And that is it for today's discussion. If anyone who is listening might have a question, please feel free to ask it now. I guess we've covered everything for all our listeners, but if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week, a great weekend, and don't forget to tune in next Tuesday. Until then, this is Scott Tomlinson signing off.